Mention a stock market crash, and people immediately picture the panicked crowds of 1929, the rapid pop of the dot-com bubble, or the 2008 financial crisis. But look at this chart. Between January 1973 and late 1974, the American stock market went into free fall, losing nearly half its value. Millions of portfolios were wiped out. Yet today, this massive drop remains completely absent from the minds of modern investors. By forgetting this specific event, we ignore a critical piece of market history, leaving ourselves deeply exposed to the exact same mechanisms that caused it. To understand how this blind spot formed, we have to look back at the 1960s. The American middle class was experiencing a period of immense economic growth and sky-high confidence. That widespread optimism poured directly into a specific group of corporations known as the Nifty 50. Investors viewed companies like IBM, Xerox, and Polaroid as being totally invincible. This chart highlights valuation, the price paid compared to actual profit generated. Moderate bars for average stocks are dwarfed by massive premiums paid for the Nifty 50. Driven by extreme optimism, the market ignored traditional math, assuming these select companies would simply grow forever. Prices were pushed to absolute perfection. And when a system is priced for perfection, even the slightest disruption can cause the whole structure to fracture. In late 1973, that disruption arrived from thousands of miles away. Tensions in the Middle East boiled over into the Yom Kippur War. In response to Western involvement, several oil-producing nations enacted a sudden, sweeping embargo. Practically overnight, they cut off the steady flow of cheap energy that the American economy relied on. The impact hit the domestic front immediately. Ordinary citizens found themselves waiting for hours in lines stretching down the block just to buy a few gallons of strictly rationed gasoline. Looking at this diagram of a factory's cash flow, we can see why this was lethal for corporations. Oil is the lifeblood of physical commerce. When the input cost of energy sharply spikes, the overall profit margins are severely compressed. The embargo demonstrated that foreign geopolitical conflicts could easily bypass American economic optimism and wipe out corporate profits in a matter of days. Because energy is required to produce and transport almost everything, the skyrocketing price of oil acted as a contagion. Basic consumer goods, like groceries, became wildly expensive, triggering a wave of rapid inflation. To stop prices from spiraling further, the central bank stepped in and aggressively raised interest rates. This made borrowing money incredibly expensive, effectively throwing a metal rod into the spinning gears of economic growth. For the previously invincible Nifty 50, this was a terminal combination. Their profit margins were already shrinking from energy costs, and now the heavy cost of debt was strangling their ability to expand. Investors realized these companies could no longer sustain their towering valuations. The realization triggered waves of panic selling on the exchange floor, ultimately vaporizing half the value of the broader market. The dual shock of 1973 proved that high market valuations are highly fragile, collapsing rapidly under the dual weight of high inflation and expensive debt. The fallout extended far beyond Wall Street traders. The rapid decline wiped out the life savings and retirement accounts of ordinary working-class Americans who had trusted the system. Consumer confidence plummeted. The public's faith in rapid, guaranteed returns vanished, giving way to a grueling bear market that dragged on for years. It took nearly a decade of painful economic restructuring, careful policy reforms, and cautious growth to finally stabilize the domestic economy. Index points are only the surface-level data. The actual damage lives in decades of lost labor, forced delays to retirement, and the deep financial trauma that haunted an entire generation. The 1973 crash teaches us that markets can operate irrationally for years. Broad diversification is a necessary, mandatory defense against that irrationality. It also teaches us that valuations eventually catch up to reality. Distant, unforeseen events, like sudden wars or supply chain breaks, can expose heavily inflated prices in an instant. We see echoes of the 1960s hubris today. When modern markets place staggering, unchecked valuations on emerging technology and artificial intelligence, they assume uninterrupted future success. Long-term investing remains a highly effective tool for building wealth, but only if an investor acknowledges that severe economic shocks are a historical reality, not an anomaly. We don't analyze a forgotten collapse from 5 decades ago to predict exactly what the market will do tomorrow. We study it because the underlying mechanics of panic and inflation consistently rhyme, and understanding them is how we survive the sudden shocks yet to come.